There are 5 questions that I get from high earning executives almost every single week, and the answers to some of them might surprise you. Let's go ahead and go through them. If you're new here, my name is Alex LaRosa. I'm a certified financial planner and financial advisor at Bluebell Wealth Management. I work specifically with executives and high income professionals to navigate equity compensation, tax planning, and build real wealth on the side of their high income. Now let's get into it. First question, my RSUs vested and I got a huge tax bill. I thought my employer was withholding taxes. This is probably the single most common question I get, and it trips up even the most sophisticated people. Here's what's happening. When your RSUs vest, your employer is required to withhold taxes. But here's the problem. The default withholding rate is on supplemental income, which RSUs fall into. And that's 22% flat. That sounds fine until you realize that if you're earning $350,000, $400,000, or $500,000 a year, your marginal rate is probably 32, 35, or even 37%, plus state tax on top of that. So the IRS gets 22% invest, then April comes and you owe the difference, and nobody warned you about it. That gap can be $20,000, $40,000, or even more. The fix is pretty straightforward. When RSUs vest, immediately set aside the difference. If your marginal rate is 37% and your employer withholds 22, put the 15% into a separate account the day the shares vest. No exceptions. Question number 2, I make too much money for a Roth IRA. Is there any way to still get money into one? Yes, this is the most low-hanging fruit that I usually find and help hiring executives with. It's called a backdoor Roth. But the first thing before you can do this is you have to make sure you have 0 traditional IRA money. If you do, there's a pro rata rule that throws it all off. So say you have 0 traditional IRA money outside, your 401k is fine, any deferred comp plans, any qualified plans are fine. You open what's called a traditional and a Roth IRA. You make a non-deductible contribution to the traditional IRA and you immediately convert it to a Roth IRA. And then bam, you have a Roth IRA contribution for that year. And you can do up to the contribution limits. So $7,500 for those under 50, $8,600 for those over 50 in 2026. This is a very, very effective and easy way to get money into a tax-free account when you earn too much to do it. Make sure you talk with your tax professional and your financial advisor before you do this, because there's some things that need notated on your tax return to make sure it is calculated right. Don't do this on your own. It's very easy to make mistakes and it can be a little bit more complicated than anticipated. If your income is high and you're not looking at doing a backdoor Roth every single year, you're leaving tax-free growth on the table. Question number 3, should I hold my company stock after it vests or sell it immediately? I want you to think about this in a different way. Forget that it's your company stock. Forget that you know the company, you believe in the leadership, you know the financials, you've watched it grow. Ask yourself this. If someone handed you a check for the full value of all of your vested shares, would you go and buy the same dollar amount in that one stock today? Most people, the honest answer is no. They're not willing to hold 20, 30, or even 40% of their net worth in a single stock. But that's exactly what you're doing when you hold. You already have your income, your bonus, your unvested equity, your career tied to this company. The stock is concentration on top of concentration. Now, there are legitimate reasons to hold some. Tax law optimization, a structured diversification plan, 10b5-1 plans for insiders, an NUA strategy if the stock is held in 401k. These are real tools. But the default of just hold it because it's going up is not a strategy. It's a feeling, and feelings have created some very large tax bills and some very painful portfolio events for executives who did not diversify. My general rule is diversify by default. Hold intentionally, never the other way around. Question number 4, my company is offering a deferred comp plan. Should I participate? Non-qualified deferred compensation plans can be generally powerful for the right person, but they come with a risk that most people don't fully understand when they sign up. And that risk is not about markets, it's about the company itself. Here's how it works. You elect to defer a portion of your salary or bonus before taxes, but that money doesn't get invested in a separate account in your name. It goes into the company's balance sheet as a liability. You are an unsecured creditor. If the company goes bankrupt, your deferred compensation is in line with every other unsecured creditor, and you may recover nothing. So the question I always ask first is, how confident are you in this company's financial health over the distribution timeline? For a blue chip Fortune 100 employer with a strong balance sheet, this risk may be manageable. For a mid-market company with meaningful leverage, it's a real conversation to be had. When it does make sense is if you're in a very high tax bracket and you expect lower income at distribution, and you can stomach the corporate credit risk. The tax deferral on the income plus the investment growth can be substantial over a decade. But this is never a default yes, it's a situational decision. Last question, I'm leaving my company. What happens to my stock options? I don't get this as often as the other ones, but it does come up a lot. Now, this is an urgent thing. When you leave a company, the clock starts on your post-termination exercise window. For most plans, that window is 90 days. There's a few others that are longer, but most common is 90 days. After that window closes, any unexercised options expire worthless. I've had people come to me who have lost 5 or even 6 figures of option value, not because the stock dropped, but because they didn't know that the window had closed. By the time they remembered to exercise, it was too late. The other issue is the ISO to non-qualified conversion. Incentive stock options have favorable tax treatment, but that treatment only applies if you're an active employee at exercise. If you leave and your 90-day window is still open, your ISOs technically convert to non-qualifieds on day 91. That changes the tax treatment entirely. And the spread at exercise becomes ordinary income, not long-term capital gains. So if you're leaving or thinking about leaving, first thing you do is pull up all of your option grants, identify every option type you have, ISOs, non-qualifieds, the strike prices, the quantities, the post-termination windows, and the current stock price. Then run the numbers before you give notice, not after. So there you have it. Those are the 5 questions that I hear almost every week. And if even one of them made you stop and think, that's the point. The executives and high earners who actually build wealth aren't necessarily working harder than everyone else. They're just asking better questions earlier. If you want to dig into any of these, RSUs, backdoor Roth, deferred comp options at a job transition, I work with executives and high income professionals every day at Bluebell Wealth Management. There's a link in the description for a 15-minute call. No pitch, no conversation, just love to help.